بسم الله الرحمن الرحيم والصلاة والسلام على رسول الكريم. السلام عليكم ورحمة الله تعالى وبركاته. And welcome to Fiqh al-Muamalat online course. And today's sessions is about the differences between the Islamic finance and conventional finance. In addition, what has been highlighted and discussed before, today we'll try to be more focused by looking at the segments, meaning that we look at the Islamic banking, then we look at the takaful, then we look at the Islamic capital market. Then we'll try to see what are the main differences between the Islamic side and the conventional side. And we start with the Islamic banking. Let's try to highlight some points. And we start with the point number one, whereby in the conventional banking, Sharia has no space. Meaning that in doing conventional banking, there is no appreciation of the positions of Sharia and its requirements in doing banking transactions. Whereas in Islamic banking, Sharia is the core elements that drive the Islamic business operation and activity. And basically, the Islamic banking is the getting the license, meaning the Islamic banking obtained the license, which is a Sharia-based license, allowed the institutions to operate in offering Islamic banking facilities and services in a Sharia compliance manners, of course by complying with the Sharia rules and requirements. So here we're looking at the Sharia as a core, also called elements, as core center in driving the Islamic financial institution. As a result of that, we have the Sharia compliance, we have the Sharia board, we have the Sharia review, we have the Sharia audit, and so on and so forth. The point number two is the Sharia board doesn't or the Sharia board is not regarded as a part of the corporate governance of the conventional banking, meaning that conventional banking, they don't have something called a Sharia board. What they have is the board of directors and they have the management, whereby in Islamic banking they have the Sharia board and board of directors and the management. So Sharia board is part of the structures, which is an independent corporate governance organs that provide kind of advice and guidance to the Islamic financial institutions, and they are regarded as one of the lines of defense when it comes to the Sharia preservations and protections. We have the other points that make the differences between the two is basically Sharia non-compliance activity. Sharia non-compliance activities is not prohibited in the conventional banking, meaning that they don't look at the prohibitions of Sharia, which means they can invest in bond, if they can invest in conventional stock, and so on and so forth. They can indulge into productions of pork, liquors, and prohibited meats and products, and also providing services. They can invest in gamblings and gamings and so on and so forth. So they don't have that kind of restriction, unless of course the financial institutions is under what's so-called the ethical banking. They may observe some of the criteria which are in line with the Sharia requirement, but we're talking in overall conventional banking, they don't have that kind of restrictions. But in Islamic banking, compliance with the Sharia rules and activities in doing business transactions and doing investments is an important and regarded as a prerequisite to ensure that you hold a valid Sharia banking license. So Islamic banking operation must comply with the Sharia rules and requirements. That's the reason for obtaining the license. That's the reason for establishing a different corporate governance organs such as the Sharia review, Sharia audit, and Sharia board to make sure that the operation is in compliance with Sharia rules and activities. The other differences, or the other point, is basically business activities are based on lending and borrowing. Core business conventional banking is based on borrowing and lending, borrow money and charge interest. But when it comes to the Islamic banking, they don't have what's so-called borrowing and lending. So a loan is not regarded as a means of generating income and making profit, but they depend on a real business activity and indulge in a different set of business transactions, which are sometimes trade-based transactions or lease-based transactions or a partnership-based transactions and so on and so forth. And all these types of financial transactions are Sharia compliance, meaning regarded as a valid contract to generate profit and accumulate wealth. The other point is that loan is the, as mentioned just now, loan represent the main core underlying contract in the conventional banking. That's the core one. Of course, they have some other fee-based transactions, but the core one, the bulk of it, the bulk of profit is coming from this underlying loan. Whereby in Islamic banking, loan is not regarded as a mean of generating income. It doesn't represent the core business in Islamic banking, despite that you may have a loan structure in the Islamic banking, but it is a supporting contract without being structured in such a way to generate income or structured in such a way that accumulates wealth and generate a profit, just supporting contract to basically structure some of the product. Like for example, in some of the deposits account, the loan could be structured but doesn't make or generate income for the financial institutions. But when it comes to the conventional loan, is the major underlying contract that make profit, whereas in Islamic banking we have others, like for example murabaha, musharaka, tawarruq, wakala, and so on and so forth. Those contracts are used as an alternative to the underlying loan contract used by the conventional banking. The other thing is that the risk is transferred to the clients or a third party by the conventional banking, whereby the risk is shared between the parties, meaning the risk sharing principle is part of the structures and the phenomena of Islamic banking, despite it's not really strongly what's so-called practice in Islamic banking, but that's regarded as a major process that is growing and expanding as Islamic finance industry expand accordingly. And when it comes to the law, of course, in a conventional banking is depending on a conventional law, like in the context of Malaysia, is depending on the Financial Services Act of 2013, whereby in Islamic banking is based on the Islamic law. Of course, if that jurisdiction has a specific law, in the context of Malaysia, it is IFSA, the Islamic Financial Services Act of 2013. In other country, you may have also other different law that could be used as a reference for Islamic banking. This is, it depends how is the structure of that country, whether you have a dual banking system or you have a single banking system, whether you have a provisions, what's so called in the act, or they have a separate act. That one goes back to what kind of jurisdiction you operate and what kind of legal system that you have. And of course, the money is used as a commodity in the conventional what's so-called banking, that could be sold, could be rent out, and value of money is applicable in it, whereby in Islamic banking, money is used as a medium of exchange and not commodity. So this is maybe the main major points when it comes to the Islamic banking versus the conventional banking. We'll stop here and we'll see you inshallah in the coming session. Wassalamu alaikum wa rahmatullahi ta'ala wa barakatuh.